The Fed cuts, but could this be as low as it goes? This is Macro Matters, and we're talking central banks. The Federal Reserve cut rates this week as expected, but the hawkish policymakers who didn't want to see that cut are getting louder. 2 voted for a hold, and 7 out of 19 said they didn't foresee any more cuts coming in 2026. That's a counterpoint, of course, to the push coming from the White House to cut further. President Trump said again after the decision that rates should be much lower. Well, George Buckley is chief European economist at Nomura. George, what did you make of the tone from the Fed? Is it possible they don't go any further in the next year?
I suspect they probably won't go any further under the current chairmanship, under Powell. I think what's more likely is that the strength of the economic data will prevent Powell and the current makeup of the Fed from cutting. But then we will see cuts coming after he is replaced in the middle of May. So we wouldn't be surprised if we see another rate cut towards the middle of next year, maybe another one after that. But I'm not really sure the Fed has got anything more in it than that.
Well, we know President Trump wants lower rates, but are you confident that the Fed, under a chair that he's appointed, will stay anchored to economic data, or might they go too far?
Well, I think they will. I mean, and I suspect that if they are to cut interest rates, that you will need to see some evidence to support that case, because the Fed is made up, as we've seen just this week, by the fact that there were quite a number of dissents on the Fed. The Fed is made up by more than just the chair. The chair, of course, is the most important, and can carry a lot of members with them. But I think it's still the case that you need to get the data to be at least sort of supportive of a rate cut in order for everyone to get on board and enough members to get on board to pass that.
Well, in other developed markets, talk has turned to how soon rates might be hiked, especially in the Eurozone. What are you expecting there?
Well, certainly markets have really taken out any risks of a rate cut from the ECB. We think that economic growth is not really that far away from its trend, or it probably won't be over the next few quarters. We've got inflation, which is very close to target, just a little bit above. And we've got interest rates, which are bang in line with what the ECB thinks is neutral. So I can't really see any need for the ECB to move interest rates by much. That's why we keep hearing from President Lagarde and other members of the ECB's governing council saying that rates are in a good place. So I'm not sure there's any desperate need for the ECB to move policy rates right now. I understand the markets clearly are focused on the upside risk thereafter, but just worth noting that there are quite a number of downside risks to inflation coming through, whether that be from wages, whether it be from the rise in the euro over the course of the last year. All of this is pushing downwards, and also China, of course, potentially, and some evidence of China dumping products into Europe at a lower cost. So there's a lot of evidence that there are downside risks to inflation. So we're not convinced that the next move will be in 2026. We think it could be beyond that.
What about the Bank of England then, where of course inflation is still stubbornly high in the UK, but the rate isn't seen as neutral yet either? How much space do they have to move?
Yes, and I think there probably is a bit of space here, because if you look at the data that we've seen between the November MPC meeting and where we are right now, so just a week before the MPC meeting in December, almost all of that data has been negative. It's been a lot weaker, and particularly the important parts of that data, whether that be things like inflation, labour market, GDP, PMI surveys. All of those things have come in softer, and I think that is certainly supportive of a rate cut in December. Where we go from there afterwards, I think, is a little bit more uncertain, of course. I don't think the bank is prepared to move rates that quickly. They will still be keen to look at all the data in the round and make sure that they don't go too fast. Certainly some of the hawks on the committee, and we think the next move after December would be in April. That coincides with the bank's monetary policy report and its new set of forecasts. But I don't think they're willing to go any further than that, assuming that we don't see a collapse in growth or inflation fall more quickly than we think.
What does this all mean for bond markets? Borrowing costs staying higher in several big economies than perhaps the market expected a few months ago is not great news for bonds, given the scale of government debt globally, is it?
No, it's not. But I think there's a few ways to think about this. I mean, if bond yields are rising because of concerns about fiscal sustainability, then I'd agree with you. I think it would not be good news at all. But if bond yields are rising because the expectation is for better economic growth, then I think that that would be okay, because of course when you think about fiscal sustainability, we're always trying to divide some fiscal metric, whether it be debt or deficits, by GDP. And of course, if GDP is going up, that will make the metrics a little bit better. I think the worst possible case would be if interest rates are going up because of concerns about fiscal policy, or if they're going up because of concerns about inflation. I think in both of those cases, we would be a lot more worried than if interest rates were going up because central banks were a lot more encouraged by the state of the economy and the economic outlook.
That was George Buckley of Nomura. Don't forget, you can watch more videos on Reuters.com.